One of my favorite uses of technicals is finding stocks that are oversold and riding the bounce back. And I'm going to do that in 3 different ways. Essentially, I'm going to show 3 different buy the dip strategies. But first, I'm going to explicitly demonstrate the power of this intersection between human visual computational power and machine computing power. And by the time I'm done, you'll have an S&P 500 strategy as well. One of the most common perceived bullish triggers for the S&P 500 is when the 10-day EMA crosses up through the 50-day EMA. So let's just see how that's looked over the last 10 years. I will add an EMA when it crosses up through the 50-day. If we come down to the chart, we can see how many times it's occurred. Every time you see a green arrow, the 10-day EMA crossed above the 50-day simple moving average. Eyeballing it doesn't tell us a whole lot other than the S&P 500 has gone up over the last 10 years. But if we turn to the computations on the right-hand side and just focus on 1-month trades, so every time this triggered, holding the stock for 22 trading days or 1 month, what happened? We see a great win rate, right? Seems like a good idea. Seems like this casual but often used trigger is effective. But that's a vanity metric. Look at the average return, 0.5% over a month, while the max drawdown was 17%. This yields a CML efficiency score of 0.03. We generally want to see this number above 0.8, and it's at 0.03. The efficiency score is simply the average return divided by the max drawdown. So it's the average return for every trade, winner or loser, divided by the single worst return at any point for any of the trades. We want to see the average return pretty close to the max drawdown, and it's nowhere near. When we turn back to the chart and eyeball it, can't see any obvious improvement simply by eyeballing. It just looks like a collection of triggers, a collection of green arrows. So now we have to lean on computational power. All I want to do is try this exact same idea, but only do it when the S&P 500 is actually below the 200-day moving average. The idea makes sense. Buy the index when it is in technical failure, so when it's below the 200-day SMA, but when it shows some momentum recovery, when the 10-day moving average crosses above the 50-day moving average. So let's add the stock price being below the 200-day moving average. Now we see far fewer trades. But if we look at the computations, that is simply where was the stock 22 trading days later after a green arrow triggered, we see a higher win rate, but all of a sudden the average return went from 0.5% to 3.7%, so more than 7-fold higher, while the max drawdown dropped by 75%. We can now see that in the CML efficiency score. We went from 0.03, which is awful, to an efficiency score of 0.84, which is rather strong. This is why our stock charts as traders need to evolve. They need to do better. Our tools need to work for us. So now we have created an open rule. We might as well finish this off by creating a closing rule and add another arrow to our quiver of strategies, this one in the S&P 500. So I'll just scroll to the top and click Test Trigger. And I want to do the simplest thing possible. I just want to buy an at-the-money call, so get long a call. And my closing rule will be even simpler. A 50% stop and a 50% limit. And that's it. And let's see how this strategy is done. Over 10 years, this has only happened 9 times, but if we're buying an at-the-money call, which is also called a 50 delta call, it won 7 out of 9 times with a 243% return. We can then look at the 5-year results. 4 wins on no losses and a 221% return. Again, this trade doesn't occur often, 4 times in 5 years or 9 times in 10 years, but it's certainly another arrow in our quiver. And now you have one of my favorite SPY call strategies, and we haven't really gotten to the heart of the demonstration yet. We've just seen how powerful the simultaneous and instantaneous computational side with the visual side has created a trigger for us. Let's go back to the Create tab and start the formal demonstration for buy the dip triggers. We will now examine 3 straight down the middle buy the dip triggers. I'm going to use Tesla for these examples, but I discuss the rigor of all of these signals later. That is, I will discuss not just its utility for Tesla, but its utility over the last 13 years for hundreds of stocks. So not just one chart on one stock at one time, but rather hundreds of charts on hundreds of stocks, thousands of times. To start, we'll look at the aggressive oversold condition of the RSI being below 25. Using the computers in our brains that's attached to our eyes, we can see the times this event occurred. And roughly speaking, yeah, it looks good. Here are the triggers. Looks like the stock does rally. But repeating the mantra, why only eyeball the results? Our goal as traders is to profit. Trading to profit and eyeballing don't go together. So, on the right-hand side, we can instantly see the results of something very simple. Just getting long stock for a certain number of trading days. And this time we will focus on 2 weeks, 10 trading days, right here. We see this has happened 9 times in the last 3 years. The average return in just 2 weeks in Tesla stock was 20%, and the max drawdown was 11.6%. That gives us an efficiency score of 1.74, which is meteoric. In general, an efficiency score, which is just the average return divided by the max drawdown, anything over 0.8 is good. Anything over 1 is excellent. 1.74 is outstanding. Now remember, on the Create tab, we don't have any closing rules or option strategies, but together we are building a trigger that is worth our time to then take the effort to build a closing trigger. We are after speed and precision. We are looking to simultaneously eliminate unnecessary time spent and be precise in that endeavor. This is the last time we will use the Create tab for this presentation. Now, we said there was no closing rule on this tab other than simply measuring where the stock was a certain number of trading days later. The Create tab can help us find an open trigger, and it can be consumed by the backtester to find us a closing trigger and an option strategy. In other words, this is how we take an idea and turn it into trading. So I'm going to tap on Test Trigger. Now we have shifted to the Backtest tab. Let's turn this aggressively oversold trigger into an actual strategy. I like to use a call diagonal spread, which looks like this. I like to buy an at-the-money call with 60 days to expiration and sell an out-of-the-money call, 20 delta, with 30 days to expiration. I'm going to hold that for a full month, and when these short-term options expire, I'm going to close everything. Let's do that with Tesla over 10 years. We're avoiding earnings, buying a diagonal call spread when the RSI dips below 25. We see 8 triggers, 6 wins, 2 losses, and a 414% return. And while we're here, I'm going to add 3 other stocks that I like to do this with. These are stocks that have a natural bid. That is, no matter how bad the market gets, at some point, each of these stocks have natural institutional buyers to pick up the pieces after they collapse. That will be Tesla, Walmart, Ulta, and Costco. And we can see with each of these stocks, we're getting anywhere from 6 to 8 trades over 10 years, and the returns are massive. We can even zoom in and see how this trigger has done not just over the last 10 years, but just over the last year. It didn't trigger in Costco because Costco never dipped below 25 RSI, happened twice in Ulta, once in Walmart, and twice in Tesla, and here are the returns of this first buy the dip trigger. So this is just one. We have 2 more buy the dip technical triggers to discuss. But even in just these 4 stocks, we see 5 trades in a year and no losers as the stocks are absolutely collapsing and we're getting long call spreads. Even more pressing, we can look over the last 6 months. This triggered once for Tesla and once for Ulta. Both of them were massive winners. Now I want to know when this happens. That is, I want to know when the stocks I'm interested see their RSIs dip below 25. I want Trade Machine to tell me when this happens. I'm not trying to stare at charts all day. So I would tap the Add Alert button and it will automatically be emailed and texted in real time when any of these stocks meet this technical condition. But we can actually go further. Rather than testing stock by stock and figuring out which ones we want alerts for, we can just go to the Pro Scanner. We'll use the NASDAQ 100 as our ticker group, and we will use this by the sell-off model. We'll sort by the number of winners, and if I want, I can tap on a link and it will open the backtester and I can add the alert again. In this case, we'll just do Micron. Here's Micron with its 8 wins and no losses in this massive oversold condition. Then I click Add Alert, and I get an alert from Micron as well. But we've gone a step further. When you log into Trade Machine, you will land on the Today tab. The Today tab starts running scans at 7:30 a.m. Pacific time every trading day. And if something is triggering that has a good backtest, we just show it to you automatically on this page. This is where the buy the sell-off triggers would appear. So many members have stopped setting their own alerts, simply log in and land on the Today tab and check it a few times a day and manage their trading that way. I still like to set my own alerts because not everything I do is in the scanner. But with essentially no work, you can see live triggers by simply logging in. Okay, I promised 3 buy the dip triggers, and I've shown only 1. Let's build another one together. I call this one the small Bollinger breakdown. We'll go to the technical open. We're going to want to see the RSI below 30 and when the stock price crosses down through the lower band of a 2 standard deviation Bollinger. And we'll look at it over the last 10 years in the same group of stocks. Yet again, we see with Tesla, Walmart, Ulta, and Costco, these stocks with natural institutional bidders, that when the stocks break down, in this case through a lower Bollinger Band, there is a strong recovery afterwards, or so that's what the probabilities read. And by the way, for those of you that like selling put spreads instead of buying calls, we can test that too. And if a buy the dip trigger really works, then yes, while getting long could be good, getting what I would call not bearish, as opposed to aggressively bullish, should do extremely well. And really, what we should see are very high win rates. So let's do that. We will just go to a put spread and get short. And here we can see only 4 losses in these 4 stocks over 10 years. So how each trader likes to approach these triggers is very personal. But remember that with options, you should probably check a few possibilities. And I just don't know anything else that makes it easier than Trade Machine. Let's look at the past year now. Again, this is selling put spreads, and it's happened in Tesla and Ulta. I'm going to go back to that diagonal call spread and now look at the last year. We can see Tesla and Ulta again doing extremely well in the last year. And by the way, we did a diagonal call spread, we did a short put spread, but if you are very aggressive, you can also just buy a call. It doesn't have to be fancy, doesn't have to be a spread, just an aggressive bullish speculation. So we can just go long a call. And here are the results for Tesla and Ulta. Obviously, being aggressively bullish, if a trigger works, with a naked long call is going to give you the best average returns. Okay, so that's buy the dip rule number 2. Let's go back to diagonal and back to 10 years. And let's fulfill the promise of 3 buy the dip rules. This one uses MACD and RSI. I will go to technical open. I want the RSI to be below 40, so I'm leaving it more room. And I want to use a standard MACD. That is when the 12-day EMA crosses through the 26-day EMA. The MACD is a pretty strong momentum indicator, so I'm willing to look at an RSI below 40 as opposed to below 30 or below 25. And here are the results for those 4 stocks. We can see again, extremely high win rates, actually more triggers using this final model, and the returns are staggering because of the natural institutional bid in these stocks. We can go back down to 6 months, and we can see this has happened in 3 of the 4 stocks just in the last 6 months, and all 3 of them won every time. And since we have the power of computation at our fingertips, we might as well look at short put spreads also. And as we would expect, a buy the dip trigger that's effective would also be a good sell put spread trigger. And we might as well check naked long calls as well. And we can see the results of a successful buy the dip strategy. Again, I can set alerts for all of these, so I don't have to watch the whole market for any stock that sees its RSI dip below 40 and its MACD crossing by just clicking the add alert button. So we did it. We found 3 buy the dip triggers. They might overlap sometimes, and that's great, but many times they do not overlap. We have set alerts. We have tested them over 10 years, 1 year, and 6 months with a diagonal call spread, a short put spread, and long calls. Whatever your trader preference is, you would find higher win rates with short put spreads. You would probably find higher average returns in long calls, and the diagonal spread would be somewhere in between. And that's it. There are no guarantees, so we use probabilities from the past as a guide. But over the long term, with enough different triggers that have been tested properly, it's our view at Capital Market Laboratories that yes, this is how you do it, or at least this is one way to do trade discovery and analysis. Thanks for watching.